PMI has a terrible reputation. Is it actually as bad as everyone thinks?
PMI is the mortgage industry's most misunderstood expense. You see, buyers will do almost anything to avoid it, whether it's putting 20% down, drain their savings, buy a less expensive home than they wanted, and half the time the math doesn't actually support any of those decisions. The irony is that avoiding PMI sometimes costs more than just paying for it.
Let's set the scene. Where does PMI actually come from and why does it exist?
Okay, so PMI, which stands for Private Mortgage Insurance, is a policy that protects the lender, not the borrower, if the borrower defaults on the loan. Lenders require it when a buyer puts down less than 20% on a conventional loan because a smaller down payment means less equity cushion if the property needs to be sold in distress. The cost varies, typically somewhere between 0.15% and 0.55% of the loan amount annually, depending on your credit score, loan-to-value ratio, and the specific insurer. On a $400,000 loan, that's roughly $600 to $2,500 a year, or $50 to $208 a month added to your payment. That's a real number, and I understand why buyers want to avoid it. But here's what I want people to understand. PMI is not a permanent expense in most cases. And in the current market, where home prices in Colorado and nationally have appreciated significantly, the calculus around PMI has changed in ways that aren't obvious.
What's the biggest misconception buyers have about PMI?
The biggest misconception buyers have about PMI is that 20% down is the finish line and everything below it is a mistake. Buyers have been told by parents, by articles they read online, by well-meaning friends that you should always put 20% down and avoid PMI at all costs. And I get it. The advice made more sense in a different market environment where home values were flat and the cost of waiting was low. But in today's market, waiting to save from 10 to 20% down means sitting on the sidelines for additional months or years while home prices in many markets continue to appreciate. You see, a buyer who purchases a $500,000 home with 10% down today and pays PMI is building equity in a property that may be worth $540,000 or $550,000 by the time they would have hit their 20% savings. The math very often doesn't favor waiting. And the question isn't, should I pay PMI? It's, what does PMI actually cost me compared to the alternative?
How does PMI actually work and how do you get rid of it?
PMI is added to your monthly mortgage payment until your loan-to-value reaches a certain threshold. There are two main paths for removal. The automatic path, under federal law, is the Homeowners Protection Act. Your lender is required to automatically cancel PMI when your loan balance reaches 78% of the original purchase price. No action needed on your part, it just falls off. The faster path, you can request PMI removal when your loan balance reaches 80% of the home's current value. Not the original purchase price, but current value. So if your home is appreciated, this can happen significantly faster than the scheduled amortization would suggest. Here's what that looks like in practice. A buyer purchases a $450,000 home with 10% down. That's $45,000 and they got a $405,000 loan. PMI fires from day one. But if that home appreciates to $495,000 over 2 years, roughly 10%, the buyer now has more than 20% equity in the property based on their current value. They can request a new appraisal, demonstrate that equity, and request PMI removal. 2 years versus the 7 to 10 years it would take just through the normal loan amortization. So in an appreciating market, the timeline to remove PMI is often much shorter than buyers expect when they're sitting at the closing table.
Tell me about a buyer who changed their mind about PMI.
Okay, so first-time home buyer, early 30s, Denver area. She'd been saving for about 4 years, had $55,000 set aside, a little over 10% of the purchase price she was targeting. Her plan was to keep saving until she hit 20% down and can avoid PMI entirely. When she came to me, we ran the numbers on both scenarios side by side. At her current savings rate, she was 18 to 24 months from hitting 20% down. In that time, based on what comparable properties had done in her target neighborhood over the previous 2 years, a home she could buy today for $480,000 might cost $510,000 to $520,000 by the time she hit her savings goal. The PMI on a $435,000 loan at her credit score was going to run her about $190 a month. Over 18 months, that's roughly $3,400 in PMI payments. The potential price appreciation over that same period, $30,000 to $40,000. The math was simple, so she bought. The PMI felt painful at first, And I'll be honest, she texted me about it more than once. But 14 months later, she requested a new appraisal. The property appreciated. She was at 80% loan to value based on her current market value. And then the PMI was removed, and she had not texted me about PMI since.
Are there situations where avoiding PMI actually does make sense?
Yes, there are absolutely situations where it makes sense to avoid PMI, and I want to be clear about that. The argument isn't that PMI is always worth paying. It's that the decision should be made analytically, not emotionally. There are cases when putting 20% down is the right call. If you have the 20% down readily available without draining your emergency fund or eliminating your post-closing reserves, and the PMI cost is significant relative to your loan, putting 20% down may make straightforward financial sense. There are also lender-paid PMI options where the lender covers the PMI cost in exchange for a slightly higher interest rate on the loan. Depending how long you plan to stay in the home, this can actually be cheaper than buying paid PMI over the relevant time horizon. And in markets where the home values are flat or declining, the appreciation argument for accepting PMI weakens considerably. The calculus changes with the market. My point isn't always pay PMI. My point is run the actual numbers for your specific situation before you let a 3-letter acronym drive a decision that can cost or save you tens of thousands of dollars.
What's the mistake buyers make most often with PMI?
The biggest mistake buyers often make with PMI is not tracking it after closing and letting it run longer than it needs to. Once the PMI avoidance battle is lost and buyers are paying it, many of them just accept it. They set up auto pay, it comes out every month, and then they stop thinking about it. They don't track their home's value, they don't monitor their loan to value ratio, and they don't request removal when they're entitled to it. Under federal law, lenders must automatically cancel PMI when you reach 78% loan to value based on the original purchase price. But the request-based removal at 80% of current value, that's on you. The lender is not necessarily going to call you and say, hey, your home is appreciated and we think you should get a new appraisal. You have to initiate that conversation. So set a reminder every 12 months after closing, get a rough estimate of what your home is worth and check whether you're at that 80% loan to value. If you are, call your lender and start the removal process.
What should a buyer do right now if they're weighing this decision?
The first thing a buyer should do if they're weighing this position is get the actual PMI cost for your specific loan. It varies by credit score and loan to value, so don't use a generic estimate. Get the real numbers from a lender who can quote it for your specific profile. Second, model both scenarios. What does it cost you to buy now with PMI versus waiting until you hit 20% down? Factor in potential appreciation in your target market and what the price of the same home might look like in 18 to 24 months. And be honest about your numbers, not optimistic. Third, if you're currently paying PMI and your home is appreciated, call your lender today and ask about the removal process. You may be entitled to remove it sooner than you think.
Where do people find you to run those numbers?
Yeah, if you want to reach us to find more about these numbers, you can schedule a call with me at teamaronheim.com. I'll run the PMI scenario against the weight to 20% scenario for your specific situation, purchase price, credit score, target market, and current savings. The math usually makes the decision pretty obvious once you see it laid out. Or text me at 720-248-6892. PMI is a 4-letter word in this industry. Sometimes the math says pay it anyways. Let's find out if it's one of those times.